Hello, and welcome back to my channel. This is your girl Chandra here with Essentially Chandra. And so, listen, today I want to kind of talk to you guys about something that I think is very important. So, since I'm kind of new to this thing of um, creating online, as far as stepping into my era of being a semi full time content creator and a YouTuber, um, there is some things that we really need to talk about, guys. Okay, and since many of you may or may not know, I am a tax accountant and I've been doing this for many years, 20 plus years in this industry. And I consult with a lot of different taxpayers throughout the year. And one of the things that I'm starting to see a lot of, which I've always seen this, but one of the things I think is very important. I've said this before on probably a previous video, or if you've seen any of my videos from any of my other social media platforms, then you know I talk a lot about tax planning and I talk a lot about keeping your records in order. Okay. So I'm still going to be on that no matter what. But today, I want to talk about something that I think is very important, or I think it's probably going to, I hope it's going to be useful to you guys, those of you, my lovely people who are creators and YouTube vloggers, content creators, YouTube vloggers, all of you. So I hope the information that I'm going to share with you today is going to help you be able to know what you can and cannot deduct on your taxes as a content creator and a YouTube blogger. And we're also going to be talking about how to be a good steward, all right, of all of this. All right, so let's get into it. All right, so I'm going to be looking at my notes here for a second. So one of the things that I really want to talk about for sure, in this video, and I'm gonna try to make this video as quick as possible. But some of the things that we talk about is making sure that you are deducting everything that you can deduct and not get audited. So we're going to talk about some of those things, trying to help you distinguish between fiction and what is factual. All right. Okay, so just think about it. 'Tis the season, right? This is the season. The tax season has opened up, and everybody is scrambling. Everybody is ready to get those taxes done, and I get it, right? We want our money, and we want our money now. Okay, but think about this for a minute. What if you receive a letter in the mail from the Internal Revenue Service? How does that make you feel? I mean, I know for me, if I get anything from any type of taxing authority, whether it's my federal government or my state government, my heart begins to beat and thump. And I'm like, oh, Lord, what did I do wrong? Okay. So if you felt like I felt, let me know. Give me a thumbs up or something, just so that I know that you're with me and you understand what I'm saying. Okay. So just think about it here. You receive something from the Internal Revenue Service and you're like, oh my goodness, what is going on? What has happened? It's the one thing. This is the one thing that keeps every content creator I know awake at night. Okay, this is the one thing that I know that probably keeps you guys and me included up at night. Did I deduct too much? You're wondering, did I deduct too much? Um, what type of business expense did I take? Was I supposed to take that? Did I accidentally commit tax fraud by taking those deductions? You know, the list goes on and on in your head. And believe me, I get it. I really do. I get it. And the fear is real. The struggle is real. Making sure that you are doing the right thing at the right time at all time. And while less than 1% of individual returns actually get audited, for us, those of us who are self employed, the vloggers, the content creators, um, it really does feel like we have this big giant target on our backs. And quite honestly, we do sometimes, because we are claiming a lot of deductions. Business owners incur a lot of expenses, and we are deducting a lot of stuff. And sometimes the IRS tells us, wait a minute, no, you can't, no, you don't, slow your roll, pump the brakes. All right. But the IRS knows that business returns, especially for sole proprietors, and that's usually what you are. If you are a content creator and you are not working with someone else, you are a sole proprietor. It feels like we have a giant target on our backs. And um, if we are sole proprietors, that means that in a lot of cases we have a lot more opportunities for creative accounting, is what I want to call it, creative accounting. And with all the bad advice that's swirling around on social media and on TikTok, and everybody's telling you that you can, you know, do this, that, and the third, and, you know, receive this big tax deduction or get thousands of no, it's so much information that you are being bombarded with online, and you don't know how to decipher through it. It really is a total minefield. Okay, it's a minefield. And one influencer, could be online telling you that you can write off your new truck, while another one says that your daily office coffee is a business meeting. Like, who are you really supposed to believe when you're getting all of this information? So right now, what we're going to do is give you your survival guide. Give you a survival guide, yay, on where we're going to cut through the noise. We're going to cut through all the noise, cut through all of the hoopla. We're going to kill the myths, okay? We're going to build a rock solid, audit resistant plan for your business, okay? Audit resistant plan for your business will cover what you can actually deduct, and how to do it, and how to do it right, okay? And we'll also, and most importantly, how to do it all without waving a giant red flag at the IRS saying, hey, come and get me, okay? So we want to always be doing the right thing at all times, okay? So y'all ready for this? All right, so let's just rip this little band-aid off right now. Okay, so if you're earning money from YouTube, if you're earning money from Patreon, brand deals, or anything like that, the IRS sees you as a business owner. Okay, as if you didn't already know that. You are indeed self-employed. And this isn't a hobby for you anymore. If you are bringing in money, serious money, doing YouTube, or any of these other things on TikTok or any of these other platforms, and you are doing it consistently and you are bringing in income. I'm not talking about just the big income, I'm talking about income. It could be $10 a month or $100 a month thus far, especially if you just started. If you're bringing in income, okay, then it comes with a tax bill. You understand? It comes with a tax bill, and it could be a huge shock to you if you're not ready. So you need to get ready to not have to pay a lot of money in taxes. All right, so you're on the hook for a few layers of taxes. So here's what you do. First, there's your standard federal income tax that you're on the hook for, which in 2026, this year it falls into 7 brackets, which are ranging from 10% to 37%, depending on your income and your family status. But here's what you need to understand. These are called marginal rates. Okay, these are called marginal rates, and you don't pay your top rate on all of your income. You pay only 10% on your first chunk of income, okay, and then 12% on the next, and so on and so forth from that. Then comes something else that you're on the hook for, which is also self employment taxes. Yeah, you're self-employed. So you're on the hook for self-employed taxes. Okay, so what that self-employed tax is, if you haven't noticed it already, the self-employed tax, it's a flat tax. It's a flat 15.3% tax on your net earnings. It's made up of 12.4% for Social Security, um, which is in 2026, I believe it's 180 something thousand dollars. I think it's $184,500 this year in 2026. And it's also made up of 2.9% for Medicare with no income limit on that. All right. And on top of all of that, you probably have state income taxes too. All right. I'm almost sure that you have state income taxes too. So, what does all of this really mean? What does all of this really mean in plain English? What does it all mean? So, what I like to tell a lot of my clients is that a good rule of thumb here is that you need to set aside at least about 25%, maybe even more, of every single dollar that you are making. At least 25% save, set aside at least 25% of every dollar that you're making. So, for an example, let's do simple math. If you're earning about $100,000 or more this year, you could easily owe $25,000 or more when it's all said and done. That's why it's a good rule of thumb that you set aside at least about 25% uh, of every dollar that you're earning. Also, since you don't have employer withholding this money for you, like if you notice that when you had a W-2 job, when you were working a 9 to 5, your employer took that money out for you. Well, since you're self employed, you are responsible for taking out your own money, taking out your own taxes. So, since you don't have an employer taking this money out for you, you have to pay it yourself through the year with what I call quarterly estimated tax payments. Quarterly estimated tax payments. And you do that in the form, you do that by filling out form ES. It's 1040 ES. ES means estimated. Estimated. So you do quarterly estimated payments by filling out or using form 1040 ES. Now, if you wait until April to pay it all at once, you are going to most likely get slammed with an underpayment penalty. Okay. So I would say instead of trying to pay these taxes off at the last minute, go ahead and start doing quarterly estimated tax payments. I encourage you to please go ahead and start doing estimated tax payments, quarterly estimated tax payments. All right. This is why deductions aren't just a nice little bonus. They are a critical survival tool for any creator. And every legitimate deduction lowers your net income, all right, which lowers both your income tax and your self employment tax. Now, I want to put a little bug plug here. Please don't ask your tax professional if you are using a tax professional to help you with this. Please stop asking them what else can I claim on my taxes at the time that they are preparing your taxes. This is why I always say, and I've been yelling this from the rooftops, please do your own due diligence and start planning ahead of time. Tax planning is so important because tax planning allows you to plan in advance so that you're not trying to figure out what you can do later, because now you find out that I owe something, or I don't have enough deductions, and now I owe, or I'm not getting the big refund that I think I should be getting. Well, a lot of that can be eliminated when you have a tax planning session with your trusted tax professional. I'm not your tax professional yet, but I hope that I will be. More of that later. Anyway, let's get back to it. Okay, so what can you write off? What can you write off? I know that's a question that a lot of you have. Can I write this off? Can I write that off? So, what can you actually write off? I'm glad you asked. All right, so I wrote some notes down, and I'm going to tell you exactly what you can write off. All right, so what's the IRS golden rule about things that you can write off? The IRS says that a business expense has to be both ordinary and necessary. Ordinary means it's a common expense in your industry. Ordinary means that it is common in your industry. Now, I know this is for my creators, my content creators, and my vloggers, my YouTube vloggers, social media content creators, but this also applies to every business owner. It does not matter what type of business you have. You can have a boutique, you can have an education type business, you can have rental real estate, you can have any type of small business. If you are considered self employed, you can have, it doesn't matter. Whatever type of business you have, the IRS says for an item to be a deductible expense, it has to be both, not just ordinary, but it has to be both ordinary and it has to be necessary. Again, ordinary means that it's a common expense in your industry, okay? Necessary. Necessary means that it's helpful and appropriate for your business. It is helpful and it is appropriate for your business. Okay? So, how does that apply to a vlogger's life? How does that apply? All right. So, for an example, one thing is especially a lot of you guys spend a lot of money on, and it's equipment. Your equipment. Of course, this may seem obvious, but it may not be to some. So, your equipment, the camera, lenses, mics, tripods, lighting, the very computer that you are editing your videos on are all deductible. Okay? But here's the catch with that. If you use that gear for both business and personal use, you can only deduct the business use portion. For example, if you get a new laptop to edit your information, to edit your videos on, and you also use that laptop to do some personal surfing, to pay bills, or anything like that in your personal life that doesn't have anything to do with business, then you are only able to deduct the business portion of that uh, expense. So, for example, if you use your laptop 80% of the time for editing and 20% of the time to watch Netflix, then you can only deduct 80% of the cost for using that laptop for editing the videos. If you buy a camera exclusively for your YouTube channel, then guess what? That camera is 100% deductible. Okay? You gotta be honest with yourself and you've got to keep good records. Bottom line with that. All right. So, what are some other things? What about your software? Software and subscriptions. This is nice. It's a clean type of category that we look at here. But your Adobe Premiere, if you use Adobe or what are some other, the Final Cut Pro and all of these other subscriptions, your music licensing service, stock footage sites, Epidemic Sound or something like that, any type of cloud storage, even services like YouTube Buddy or vidIQ. These are all fully deductible because guess what? It's an ordinary and it's a necessary expense. These are ordinary and necessary expenses for running your business, right? Okay, what about travel? Now, a lot of you probably do some type of lifestyle type of videos where you're traveling, come go with me, or we're doing restaurant, we're going places, you're traveling, okay? Here is where a lot of creators get tripped up. This is one of the ways that you guys are waving a red flag to the IRS and saying, come on and come and get me. We don't want that to happen. So, when you're doing travel expenses, a lot of people ask, can I write off my trip to somewhere, to Mexico? The answer to that is maybe. Okay. But you've got to be extremely careful with this. Okay. Extremely careful. The primary purpose of the trip to Mexico, it must be for business purposes. If you're traveling, going anywhere, the primary purpose of that travel, of that trip, must be for business purposes. If you go to a creator conference, your flight, your hotels, and 50% of your meals are deductible. If you fly to New York, or if you're going to New Orleans to film to film a pre-planned series of videos on your channel, that is a business expense. It's a business trip. Okay. So, in order for you to deduct travel expenses, it must be the primary purpose, must be for business. Okay. So, that means that if you are going on a trip, then at least, if not 100% of that trip needs to be for business. If 90% of that trip is business purposes and the other 10% is for personal, that means you can only deduct 90% of your expenses as a business deduction. Okay, so the primary purpose has to be for business. All right, moving on from that. What if you take a 2 week vacation? I think I kind of alluded to that a little bit earlier. What if you were to take a 2 week family vacation and you just so happen to spend or happen to film for 3 hours? That's a question. You can't write off the whole trip. Again, the IRS ain't having it. They'll look at your itinerary because guess what? You're going to have records for this, right? So they're going to want to see your receipts. You need to protect yourself and you need to keep a detailed log of your business activities. So even if you are taking a 2 week family vacation and you just so happen to film for 3 hours, you can't write that whole trip off. You're going to only be able to write the portion of that trip that was business related, not the whole trip. You need to keep good records. All right. What about for driving? If you're driving somewhere, this still goes along with your travel. If you're driving to a place, don't just guess with this one. You need to use a mileage tracking app like Mile IQ or some of the others that are available. For 2026 this year, the standard mileage rate for business is 72.5 cents per mile, and that adds up fast. All right. What are some other key deductions? You've got the internet and your phone bills. You have the platform fees. Oh my gosh, this is a huge one that people miss. I'm giving you free information. This is something that a lot of creatives are missing. Those platform fees, that 30% cut that YouTube takes off of your videos. If you are on OnlyFans, yeah, I'm talking to y'all too. OnlyFans take that 20% or the fees from Patreon. These are all business expenses that you can deduct. Okay. You've got professional fees, marketing and advertising. All right, so let's look at something else here. Let's try to separate fact from fiction. I need to do that. I need to take some time and delve into that for a second. Let's uh, take away fact, take away fiction, excuse me, from the facts. All right, myth number one. There are a bunch of myths out there. Let's look at a few of them. These are dangerous. I consider in my opinion, and this stuff is going viral, but I need to pop some bubbles on this one. Okay, so myth number one that I see is if it's in your video, then you can write it off, and it's a deduction. No, it's not. Okay, this is a one-way ticket to an audit. Remember the ordinary and necessary that I talked about? That's where that comes in at. So, for example, if you got $150,000 luxury SUV, you have to ask yourself, is that a necessary expense for your channel? Especially if you got a channel talking about personal finances. Is that really necessary? You see where I'm going with that? Yeah. Myth number two, you don't have to report income if you don't get a 1099 form. Wrong. You do. Pop that balloon. Yes, you do. Um, the reality is that you are legally required to report all income, whether you get a tax form for it or you don't. You got to report all of it. If a brand pays you $500 on PayPal, that's taxable income. The $600 threshold is just the point where the payer has to send you and the IRS that form 1099. That doesn't mean that just because the threshold they sent you, you were only paid $500, so it's under the $600 threshold. That's not what that means. If you got paid $500, that's taxable income. As a self-employed person, you have to report all of your income. Okay. The IRS knows whether you get a 1099 or not. The IRS knows, and they will find you, and you can get penalized for under reporting your income. Underreporting your income. So we don't want to mess with the IRS. So not reporting everything is one of the easiest ways to get an automatic notice and get an audit. We don't like audits. That's one of the quick, surefire ways of getting audited. All right. Number three, one of the other myths that I've heard is a write off means the item is free. It's like getting money back, right? It's free. It's like getting money back. Mm-mm. No, no. Nothing in life is free. A deduction is not a dollar for dollar type of thing. Credits are dollar for dollar, but a deduction is not. A deduction is just what it says. It's a deduction. A deduction simply reduces your taxable income. So if you're in the 24% tax bracket and you have like $1,000 deduction, that only saves you what? $240. Okay? That it only saves you $240, not the full $1,000. Okay? Deductions are awesome. They are great. And we should use them. We should use them. But they don't make spending money a profitable activity. Don't spend a dollar just so that you can save 24 cents. All right? Don't spend a dollar just so that you can save 24 cents. So listen, this is a very long video, but I hope that I've been giving you guys a ton of information so far, and we still haven't even touched the most confusing deduction of them all. But listen, if you want to hear more, then go ahead and like and subscribe to this video. Turn on your notification bell so that you will not be left out of more tax tips. I will be releasing videos just like this one to help you master the business side of being a creator. All right, so add a comment below and let us know that this has been helpful to you. And of course, I will be giving you more information. Now listen, let me say this. At the end of the day, at the very, very end of the day, God wants us to be good stewards. And even down to your taxes, we are supposed to be good stewards of the money that we have, of the business that we have. Our business um, is something that we use to take care of our families, right? And this is something that you have gotten into because you want it, number one, because you enjoy it, and number two, because you wanted to use it as a form of making money. So listen, taxes for creators, they can be a doozy, no doubt about that. But fear comes when we're talking about taxes, fear comes from not knowing what you can do and what you can't do, or not necessarily not even knowing, but not understanding, for lack of a better term, I guess, not understanding what you can and what you can't do. Number one, you need to start taking meticulous records. Good record keeping is not a suggestion here. All right. The good tax lady is telling you if you don't keep good records, you stand a chance of really putting yourself in a situation um, that could cost you lots of money. I used to say lost receipts equals lost money. And I still believe that even to this day. Another thing I would caution you about is not to get greedy when it comes to this kind of stuff. Taking deductions that are massive compared to your income is a huge red flag. If you're only making $45,000 a year or $20,000 a year in your business, small or high, if you're making $20,000, it doesn't make sense for you to write off $10,000 to $15,000 of expenses. That's a red flag. If you make $45,000, don't write off $30,000 to $40,000 worth of expenses. That's a huge red flag. You are basically asking the IRS to take a closer look at you. Okay? Be realistic, be honest, pay your quarterly taxes. Pay your quarterly taxes. If you don't want to be on the hook for these taxes on the back end, you need to start paying your estimated quarterly taxes now. As I've covered before, failing to pay your estimated taxes on time, it could lead to penalties. It also signals to the IRS that you might not be on top of your own finances, which can invite more scrutiny. We don't want the federal government to get any more than our money than is necessary. We want to render unto Caesar what is Caesar's, okay? We don't want to overpay our taxes if we don't have to. And one of the other pieces of advice that I would give you is you need to hire a professional. I know it's tempting to save a few hundred dollars trying to do it yourself or using, tax software, but a good tax professional like myself who understands the creator space or is getting to a place where we understand the creator space. Even if we don't really understand the creator space, a person like myself who's been doing this for so many years, I understand taxes. And I know what those things are that you can and cannot deduct. All right. So, hiring a person like myself, that's the biggest and the best investment that you can make in your business. Hiring a professional. We can find you deductions that you miss. We can make sure that you are compliant. And for a lot of us, we can represent you if you ever get to a place where you get that dreaded letter that comes to you in the mail that I was talking about earlier. Like your heart starts beating. So, hiring a professional is one of those things that you should really consider. And the best part about doing that is, guess what? The fee that you're probably going to be charged, it's deductible. It's deductible. All right. So yeah, I get it. Like I said, this is more than just avoiding an audit. It's about an honorable business. It's about being an honorable business owner. And the Bible tells us about being good steward of the resources that we're given. You understand? Your business is a resource that you've been entrusted with. And so managing your finances, managing your taxes with integrity, paying what you owe, rendering unto Caesar what is Caesar's, without overpaying is a part of being a good steward. Okay. We already know that the Bible talks about being a good steward all the time, everywhere in the Bible. Romans chapter 13, verse 7 says to pay to all what is owed to them. We already know. But at the same time, I don't want you to be scared about taking your deductions. Okay. Just be smart about it. Be honest and be a good steward. All right. So listen, if this breakdown has helped you feel a little bit more confident, do me a favor and hit that subscribe button. And I hope that you've enjoyed me today. Again, hit that subscribe button, turn on that notification bell so that you will not miss another release of another video for some tax tips this season. Drop a comment below with some of the craziest tax myths that you've ever heard about. All right. So, all right. I hope that you guys have enjoyed me today. Go on and make some good, smart money moves. I'll talk to you later. Bye, y'all.